Yeah, 1 second, Rajiv. I'm
Yeah.
starting the recording.
No, I'm just checking whether I'm audible or not.
Okay, sure.
Yeah.
So, hi everyone. I think we can get started. Welcome to the workshop session of our competition Quant Quest. I'm Samritha, a coordinator of the Finance Club IIT Madras. Today, we are privileged to have Mr. Rajiv Fatke and Mr. Akhil Jain from AlgoBulls to lead our workshop. I'm pretty sure that most of you have already heard about AlgoBulls. For the ones who haven't, AlgoBulls is an algorithmic trading platform that provides AI-driven strategies for retail investors. It provides a platform where both trading experts and coders can build their own trading strategies and even monetize their expertise. I'm not taking much of your time here. Mr. Rajiv will be leading the session on market and trading strategies. So let's kickstart the session with him. Over to you, Mr. Rajiv.
Okay. Thank you. Thank you, Samartha. And good evening to everybody. So hopefully we will have a good discussion about an hour or so on the market, etc. Initially, it will be from one side. I'll be speaking about whatever I have to present, and then later on we will have a question and answer session. So basically, we thought that we all, as technocrats, don't pay much attention to the business aspect of the programming. So whatever applications that we might be developing uh, is being used by the end user community, and unless we have the proper understanding of what their needs are and what is the environment that they are operating in, it becomes a little difficult for programmers to deliver whatever they are expected to deliver. So with that thought process, we thought that we should organize one such session where all the competitors who are participating in this competition will get some idea about what market is, what the stock market is, what is the trading, and what is investment, etc. So with that preamble, I will just start with my slide. So the first slide talks about the stock market, investment and trading. So generally there is a lot of confusion in the minds of the general public that stock market is a gambling kind of a thing. Is not meant for ordinary people. Of course, that used to be the case in our times. Now people have become more aware. They understand what it is, but still we need to understand the difference between the investing and the trading. So investment actually is for long term, like you would have heard or you would have seen your parents uh, having stocks that they had purchased as a IPO, and they're holding it for years together for 10, 20 years, and they are making money out of it. So whatever 1 lakh that they might have saved or and invested, they would have been uh, they would be sitting on the pile of crores of rupees on that using their investments. So investment is usually for a long term kind of a thing. It's usually based on fundamental analysis. What I mean by fundamental analysis is that generally people look at the company's its quality, what kind of management it has, what kind of past performance it has, what are the business potential that it offers, and what is the growth potential. So all these things constitute the fundamental analysis. They don't look at the charts and the indicators and things like that that we will see in the trading. So that's about the investing. It's usually for a long term. It's not like buy today and sell tomorrow. Whereas trading has three subdivisions, I would say: swing trading, short term trading, and intraday trading. And it is based upon the time duration for which the positions are held. For example, the intraday trading is do something whatever you want to do today and close it end of the day, come out of the trade and go to bed peacefully at the night. So it's just one day game, and come out of that and no carry forward of that position. Whereas short term trading is typically it goes from start of the month to the end of the expiry for that month or for that week. Some instruments expire every week. So that's 1 month usually is the term that is used for uh, the period that is used for short term trading. And against that, the swing trading is that you hold it for a longer duration, maybe months, 2 months, 3 months, and based upon your understanding of the market and the stock, you decide whether you want to carry on or you want to exit that position. So these are the two main types of investment and in the market, investment and trading. And for both of them, we need screeners for stock identification. So that is where the IT community comes into the picture. For investment, also, we need screeners as to which stocks we should hold in our portfolio and keep track of. And also in trading, also we need to have screeners to find out which are the stocks that I should take positions tomorrow and exit tomorrow. So both of the types of these tradings, we require screeners for identification of the stocks. So with that behind us, let us also look at what are the requirements, what are the needs of the market participants. So for both investor as well as trader. So it is for for any business application that you work with, similar requirements are there in those applications as well. But still, for the completeness, I thought we should go over that just to reinforce our understanding what all things are required to be paid attention to while we are developing our software for that. So most important thing is accuracy, catching the exact price levels, stop losses, targets, etc. So when we talk about moving averages or when we talk about other indicators, it is humanly impossible to do all those calculations accurately uh, at a real time. So the first important aspect is the accuracy, and then comes the volume of data. So I talked about various parameters that the investor takes into account when he thinks about investment. It is the quality, it is the management, it is the past performance, it is the business potential, future growth, a dividend record, etc. So all that requires volumes of data. And similarly for technical trading also, if you have looked at any charts, uh, some of your elders might be using, now it requires a lot of data to be analyzed, processed, and in some inferences to be drawn from that. So the second aspect is volume, so accuracy and the volume. And data analytics is the logic that one has to incorporate. For that also we need to be ready with our various algorithms, various structures and things like that, which we typically use in our software programming. Next point is the timely execution. So timely execution is important because uh, you cannot afford to miss the opportunity. If the certain trigger is generated for a particular trade, and if you don't act upon that immediately, you lose that opportunity and to make money out of it. So in that sense, the timely execution is very important. There are also the other legal requirements. For example, if you are not exiting your intraday position, you get penalized for that by your broker, because he has to execute and close the your trades that you have taken for intraday. So for that also, the timely execution, timely exiting of the trade at the end of the day is also important. So in that's where the timely execution comes to the picture. And secondly, you don't have to sit in front of the terminal all the time, because your algorithm takes care of all the timely execution uh, aspects into consideration. And last but not the least, the most important is the overcoming emotions. Most of the time, what happens is retail trader gets carried away by the emotions. If he's making profit, he thinks that he will make some more profit going forward, and so he carries the position and ends up losing the profitable position that he had. Similarly, if the situation turns into a loss-making situation, he still is hopeful. He thinks that things will improve. Now the price will go up and things like that. So he continues with the trade and ends up incurring huge losses. So once we have objectivity in our decision making, these kinds of things, the greed and fear, as you might have heard about, those aspects, those emotions are taken care of, because the control is with the software that you have developed. You have instructed the program that I want to do this, and accordingly, this software will take care of the execution. So it ensures that there is an objectivity in your decision making. So these are the requirements, the needs of the market participants. So naturally, one would think that where does this strategy fits in? So before we get into the strategy part, uh, I thought that we should understand some basic concepts that are involved in the stock market. So these are the basic concepts. Fundamental analysis and technical analysis we have covered. Fundamental analysis looks after the quality of the company, the profitability of the company, the valuation of the company. The company might be good, but if it is costly, then investor may not prefer to invest in that. Similarly, if the uh, valuation might be cheap, but if the fundamentals are not good, people may not be willing to invest even though the price is cheap. So those are kind of aspects that are taken required in fundamental analysis. Technical analysis we'll see later more in detail as to what is involved in technical analysis apart from charts and oscillators and indicators. Now, there are various other techniques. If time permits, we will cover that. But suffice it to say at this stage that technical analysis consists of analyzing the stocks based upon its technical parameters. Basically, it is price and volume. All the indicators that are created by various analysts are based upon the price action and the volume action. So, based on that, they have devised different indicators, different oscillators, and things like that. There are various chart patterns, so to say, within the charts. One can study those patterns and infer as to what will be the trend going forward for this particular stock or for this particular market or for this particular index. So that comes under technical analysis. The next point is about the types of trades that one takes. So there are three types mainly: options trades, futures trades, and cash trades. So I will briefly explain each one of them. So cash is basically like you go to the market and buy anything, buy any goods. You pay the cash and you buy your vegetables or buy your electronic goods. So it's a cash transaction. And similarly, you buy the stocks by paying the cash that you hold in your demat account. So you exchange your demat account cash and get these stocks in your demat account, credited to your demat account. So that's the cash. What is the disadvantage here? You have to pay the entire cash. Suppose if you're buying 100 shares and its price is 100, so 100 into 100, 10,000 rupees you have to pay in cash. So that is the disadvantage of cash, because it requires huge amount of balance in your account. If you want to buy larger quantity, you will have to shell out more money. Whereas in futures, it allows you to buy the larger quantity at a smaller margin, as they call it. Margin is nothing but the broker holds up some money from your account for the trade that you take in futures. So, for example, if you are buying ITC shares, its price is 500, so you probably can buy 1500 shares in future, for which otherwise you would have required almost 7.5 lakh of rupees if you were to buy it in cash. But you can buy it at one third of the money, like 2.5 lakhs of rupees. You can enter into futures agreement, futures contract. So that is the advantage of the futures. So you can get a leverage benefit. With a smaller amount, you can have a bigger trade. So if you are confident about your trades, then you can uh, leverage your trade with the help of margin and take larger position, and in process make larger profits also. But the risk there is that if your view goes wrong, and the market goes in the opposite direction than what you had thought, then you are likely to make more larger amount of losses as well. So that is the disadvantage of it. The options are the in between kind of a situation here. It doesn't require for you to shell out the entire money. You are required to pay certain amount, which they call it as options premium, which is even one third of the futures amount that you require to pay. So with a smaller amount, you take larger amount of position. Of course, the gains are also limited because your payments are also limited, but still you are limiting your risks and increasing the possibility of your gains. So that's where the options come into the picture. So some of you might be aware that there are two types of options. One is the call option and the other one is put option. So option is nothing but you're buying an entitlement for a future trade. Like for example, if you intend to buy a house from a particular uh, owner of a certain house in the premise in the area nearby your place, then what you would tell him that you take this money, but do not sell it to anybody else till this month end. I will get back to you and I will buy it from you at this and this price. So that this and this price that you agree upon with that owner is the contract price, and the money that you pay to him for putting a hold onto that property for you is called as a options premium. So you are buying an option, so you are entitled for buying that house at a later period at the agreed upon price. So you are an option buyer, and the house owner who is intending to sell it, he is an option seller. So he is selling an option to you at a price that you have paid to him. That's an option price. So he receives that money, and you have paid that premium, so you have paid that money. So at the end of the month, if you don't want to buy that house, if you decide that you know I don't want to buy that house, then you forfeit that amount, and so the house owner, he retains that money. So that is the benefit of option selling, that you get the money as an options premium, and you also get the benefit of putting a hold on that property till the time that you have agreed upon. So that's in brief about the options. We will touch upon that in detail if later the time permits. So there is another thing that is called as contracts and open interest. So I talked about the futures and options contract. Contract is nothing but you agree upon something, agree upon a trade that you will be buying or selling at so much quantity at so much price, and that is treated as a contract, officially contract between buyer and a seller. And the open interest is these all these open contracts which have not executed till the expiry period, those are called as a part of open interest. So if you see the NSE's option chart later on, we will also have a look at that. You get to see those open contracts as well over there. So the next is the option chain and options payoff. So I think I'll touch upon this later on along with the chart example. So it'll be easier for me also to explain and easier for you to understand as well. So all these items on the right hand side, options chain, ATM, OTM, ITM positions, volatility indicators and oscillators, they form a part of technical analysis. And there is a last item is margins. So all these are required to be considered in technical analysis. So we will touch upon that later if the time permits. So with that, now I come to the strategy part. What is strategy? So as I said, uh, the investor has a view on the expected market behavior in the future. So how this view is formed by the investor? He looks at various incidences happening around in the market. There is a budget, there is an election, there is a RBI meet to decide on the interest rate, there is a war going on between Russia and Ukraine. All those things impact market. The market goes up and down. The government decides something on the defense sector, and suddenly the defense sector shoots up because there is a huge demand that is expected in the defense sector. Or if the government decides to ban rice exports, immediately all the rice producing and rice distributing companies, their stocks would fall. So all those events and the business potential of individual company are evaluated by an investor, and he forms a view on the market. So he doesn't just stop at that. He forms an opinion and then he starts thinking about what are the possible actions that can be taken to reap benefit about from those expected market actions. So that is the next step that he has uh, in his mind. So what is the possible action that can be taken? And that results into a thought process in his mind as to what should be done. And while he is doing that, while he is deciding on the action that needs to be taken, he has certain objectives in his mind that guide his overall process of uh, uh, finalizing the action to be taken. So the first and the foremost is preserving the capital. So whatever you may do, ultimately your capital should be kept intact. So there is a famous investor, Charlie Munger, who had talked about it once. He said that the first principle in stock investing is you should preserve your capital. And the second principle is you don't forget the first principle, that is preserving the capital. So that's the kind of importance that is given by all the experts in this field, that the preservation of capital is very important. If you keep losing your capital in short period of time, you will lose interest in the market and you will just switch off your trading business and go away, and you will start doing something else which you were doing earlier. So preserving the capital is most important thing, and then comes making money. So if you succeed in preserving the capital, then the next logical thing that can happen to you is you will start making money, because all your actions are primarily intended to make money. We will see how we address that making money part later. So that is the next important aspect, that you should make money. And how that money should be made? It should be made at the rate more than FD rates. Because if you're not getting the rates which are available through FDs, fixed deposits with the banks or with any other financial credible institutions, then there is no point in doing this trading and investing. So the third objective is you should make the rate of return more than the FD rates. And lastly, but uh, when you are doing all this, you should expect that there will be a certain amount of risk also. So there, your personality also comes into the picture. If your personality is totally risk averse, then the stock market is not a place for you. FDs will be the best suited uh, mode of investment for a person who is very much risk averse, because market, after all, is a market. It has got its own ways to deal with the situation. So it's possible that at times you will be making small losses also. So if you are able to stomach that, one should get into the market. Otherwise, you should stay put with your FDs. So that's how the important the risk also is, and you should be prepared for that. So finally, both these points lead to an action plan, which is a strategy, which we call it as a strategy. So strategy is a process. So all this thought process that the investor goes through is the process of developing a strategy. And finally, what you end up doing, what you end up developing, is what is called as strategy. In general terms, we call it as a strategy. So it's both. It's a process as well as is a end product as well. So that's what is a strategy. So the steps of the strategy, we can just go through what we have already discussed. Strategy as a process and as a product. It's a concept that starts with the investor's mind. In the investor mind, he thinks about it. He prepares a plan in his mind. Then he documents it in whatever form he is comfortable with, and that document is then shared with the software person for implementing that strategy, that piece of logic, into a software code, software executable. And once that is developed, we say that that strategy is developed, and that needs to be deployed at the marketplace. What is meant by deployed? It should be usable by the investor. Just developing a strategy will not be sufficient. It needs to be deployed, and for that, people like us uh, are useful, because we have seamless integration with the broker and uh, with the investor himself. So investor has got his own broking account, uh, with a trading account with the broker. He has money in that. He puts some money in the trading account for his investment activities, trading activities. And company like us helps the investor to place trades on the user's behalf with the broker. And for that, the integration with the broker is required. We have integration with as many as 40 brokers, different brokers, and you name the broker, and mostly we will have integrated with that broker. So the user has a seamless end-to-end experience. He doesn't have to bother about anything. The strategy that he has coded generates the trigger in the logic in the software executable, and the that piece of software places the trades based on the triggers that are generated with the broker, and the trades are executed. User gets communication through our system in form of the messages in the logs, and also user can look at his trading account also like he does it normally for his own trading activities, and he can see the trades being placed in his trading account, and he can monitor how much profit it is making or how much loss it is making, etc, etc, etc. So that's what we call it as a deployed at the marketplace. And uh, as I said, ultimately the intention is to make money, and also continuous improvement in the strategy. Why this improvement is required? Because our experience is that after the strategy is executed for number of days or months, it gets common. Many people start trading in the same fashion, so it loses its charm, it loses its importance, it loses its profitability, and therefore we have to look for different different strategies or different ways of handling the market situation, and that's where the development of new strategies come into picture, and that's what I call it as a continuous improvement. So this is the whole process of strategy development. So where we come into the picture as a software professionals, we come into the picture with those two central points which are highlighted, implemented, implementing it in the form of a software executable and deploying it at a marketplace. So implementing also involves back testing, ensuring that it is performing to the satisfied level, etc, and then finally deploying it at the marketplace so that user can start using it. So this is where the software professional comes into the picture. So with that, I'll go forward to some examples. So this one example is about a stochastic crossover strategy. So what is stochastic crossover? It's an indicator which is defined here. I mean, I've just given the caption. A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. So I don't expect you to understand this at this stage, but I just wanted to show you an example as to how you can. One sec. I will take you to some of the websites which you should start referring to. So, for example, this particular stochastic oscillator, this is a website called Investopedia. Some of you might be already aware of it. You can make a note of it also. It's a simple investopedia.com. You will get here the information of all sorts of things that you need to know about various indicators and things like that. So this is where I have picked up that information from. So you will get to know what that oscillator is, how it works, how to calculate that, and so on. So this is one very important site, not just about the indicators, it will give you various other concepts also. If you want to know about what is the option strategy. So if I want to search for option strategy, you can search here. Uh, if I say option strategy plus Investopedia, So you will get here Investopedia, 10 option strategies, and etc. So you will get to know various option strategies, what is the principle behind that, what is the logic behind that, and things like that. So I would suggest you start going through this website if you want to know further, understand further. There are different strategies explained as well over here. So I'll go back to my presentation. So here in just briefly, I will explain you what the strategy is, how to go about uh, coding for a strategy. Not exactly coding, but how to understand the logic behind this. So this strategy oscillator, I mean stochastic oscillator, is nothing but, you see those two lines at the bottom. One is the red line and other one is the blue line. So whenever there is a crossover, it's an trigger, as we call it. It's an indication that you can take certain action. No, so do I take action at every crossover? Probably not, because if so, these levels, top dotted line and bottom dotted line, are called as a oversold level and overbought level. So overbought level is the top line, oversold is the bottom line. So when those two lines go above the overbought levels, that means people have created a lot of positions. They have bought this particular stock in large quantities, and it is possible that it is likely to go down. So when there is a crossover of this blue line going below the red line, it generates a sell signal, as we call it. And if you see here the chart, it's actually from here it has started going down. So that is the significance of the crossover signal. And where that crossover signal happening, that's also important. So this is basically a chart of Nifty 50 index. You can look at the chart of any of your favorite companies also, and you can plot this particular index, I mean oscillator, stochastic oscillator, and you can form your own opinion. You can study this individual charts for no couple of hours, different charts, and see if you can generalize any condition which is applicable to most of the charts, and based upon that you can code your strategy accordingly. So if I find that the crossover at the level above the overbought level is yielding me good results, I will code this in my strategy as a trigger. So whenever this blue line is crossing below red line, there are names of course to it, but I'm not going into those kind of details. I'm just referring to them as a blue line crossing below red line generates a sell signal. Similarly here, the blue line has crossed above the red line and it is below this oversold level. So the situation is here oversold. The people have sold this particular instrument in large quantities and it is likely to go up now. And actually it is going up after this crossover. It has gone up from here up till here. So this is a price action. It's a it's a price action of 21st of Jan, etc. It's a 1 minute chart, Nifty 50 index. So I would suggest you also should start reading those charts, start reading those indicators, plot these indicators on the chart, and form your own opinion uh, for generating those kind of triggers. So your next natural question would be where to look at those charts. So for that, there is another uh, there is another website. Is a quite popular website amongst the traders and investors. You also can see all these charts in this particular website. It's a freely available, charting software. You can change. If I want to look at what is Reliance doing, I will say, I will select that as a Reliance Industries. So it has formed this particular chart. So here, if you see here, it has crossed above the blue line, has crossed above the red line, and it has given a buy signal. And from here, you would see it has gone up, quite significantly from 2,660 levels to 2,800, almost 200 points. So if somebody had taken this trade based on this indicator, you would have made some money. So my objective is just to show you how to read the charts, how to read about the oscillators and indicators and things like that from the other website that I showed to you, Investopedia. And this is the charting software. You can plot various indicators here also. Like this is the indicator. I will select indicator over here. Say EMA. EMA is moving average exponential. You probably might be aware of EMA, or if not EMA, at least moving average you must be knowing. You must have read it in your earlier mathematics classes. So if I plot this, I get to see this EMA line also. So here also, if you see, it has crossed above this EMA line. Some people consider that as bullish signal, and from then onwards, it has just gone up. So that is another indicator. So I've just showed you how to plot an indicator, how to read that indicator, and how to form your decisions based on that indicator. So that is about the indicator based strategy. So now we go back to our presentation. So I think I have covered everything that I wanted to show on this chart as an example of indicator based strategy. Now we will go to the other example of options chart. So before we go to option strategy, I just wanted to take a pause over here on the options chain. Uh, I will go to this website itself to explain it there. So this is a NEC site again. This is also a free site available from NEC. The key house in the trading community. It provides a whole lot of data. Actually, it's a gold mine of the information available for the entire user, trading community. So this particular piece is an option chain. So we talked about options. Now, I don't want to confuse you more, but there is something called as a option strike. So if you see here on top, currently the Nifty is an index, its price is 21,522. So if you round it off to nearest 100, it is 21,500 is the nearest round 100 number. And if I look at here, this is 21,500. And there is a color demarcation here. All the data above this line is yellow here, and all the data above this line is yellow here. So these are the put positions and these are the call positions. So I'll just briefly touch upon what is call and what is put. So this is a strike price 21,500, and that's the strike price. Why it is called strike price? Because this is the price used by buyers and sellers to enter into a contractual agreement. A buyer says that I will buy Nifty index from you at this price 21,500, and opposite to that, the seller says that I will sell you Nifty contract at this price at the end of the expiry. So expiry is at the month end. So this is now February will be starting. So next expiry is 29th of February. That is when all the contracts will be nullified. I mean, they will be executed the reverse way. Whatever position you may have, those will be closed. So that is called as expiry. So coming back to the strike price, why it is called strike price is because we are taking positions, either buy or sell. So I can buy a call option or I can buy a put option. So buy and call are exactly opposite. Buying a call option means I am getting into an agreement where I'm saying I will buy this Nifty contract at this price, and for which I am paying you 170 rupees. That 170 rupees is the option premium. Last traded price of the option is LTP, last traded price, and that is the option premium. So similarly, what is put? I am buying a put option, meaning I am getting into a contract with the opposite person, telling him that I will sell you this 21,500 contract, Nifty contract to you at this price, and for which I will pay you this money. So you be ready to buy that when I am offering you. So what is my objective here? If the price goes down, sorry, goes up, he will be still he will be still compelled to buy it at a lower price. So actually other way around. So if the price goes opposite direction, I will make money because he will still be required to buy it at a higher price, 21,500, whereas the actual price is 21,300, suppose. So that is the purpose of buying a put option. And the seller, of course, has got a opposite view. So that is where the view comes into the picture. The buyer and the seller have exactly the opposite views about a particular instrument, and that's why the trade happens. One person buys it, other person is ready to sell it also. So that's how the market works. So these are the put and call options logic. And since there are different strikes available, like I can enter into a contract at 21,450, 21,400, 21,350, and so on and so forth for call and a put. So on the left hand side, this is a call side, and right hand side is a put side. So if you see on the top, here it says put side, here it is said calls. And it gives some other information also. Like we talked about the OI. What is the OI here? So if I go back onto my earlier level, 21,500, it is having so many open contracts, so many contracts of buy and put of calls have been entered into, and they have not been closed yet. They will be closed only at the expiry. And same on the opposite side, on the put side, there are so many contracts that are open, about 75,693 contracts which are open at this particular price. And these are the open contracts for different strike prices of those options. And since it is in a serial form, in a sequence form, it is called as an option chain. So there are almost about 40, 50 odd strike prices for Nifty contract. So we might do the same thing for any other instrument also. Just one second. So instead of selecting Nifty, I can select ABB, for example, or maybe Adani Enterprises. So it gives me data about this option chain about Adani. What is the open interest position? What is the LTP of the options for that particular strike? So at this 3,100, this is called as a ATM. Why ATM? Because at the money, it's called as at the money, And why it is ATM? Because currently the Adani price is 3096. So its nearest 100 is 3100, and this is the price which is the ATM price, at the money price. So here you would say the color changes from yellow to white and yellow to white on the other side for the put options. So this is the ATM price. The yellow numbers that are there, that are those are called as in the money, ITM price. Why ITM price? That's because at the end of the expiry, you will still get some money out of that contract if you have purchased it. So for example, if the market ends at 3100, and if you had bought it at 2900, then you would have gained 200 rupees here, and therefore it is called as in the money. So whatever positions you are holding, it has some monetary value. But if you had bought this 3300 options, suppose, and the market is ending at 3100, nobody will want to buy it at this 3300, because if something is available at 3100, there is no need for me to buy it at 3300. So I will let that option expire worthless at a zero price. Whatever premium I had paid for buying that call option would be forfeited. It will be pocketed by the seller who had sold that to me. So therefore, this is called as out of the money. Means it doesn't have any intrinsic value. It will be zero when the contract expires at the expiry. So that's the brief description about ATM, ITM, OTM, option pain, the premium, option premium, LTP, and the open interest. They also give the data like change in open interest, whether there is any interest, in people's mind to buy this. For example, there is a reduction in the open interest. So people are covering up their positions in here, thinking that no, it is not going to, get me any profits. So let me come out of that. So that is the significance of this negative change in the open interest. At the same time, here it is positive. So this tells us exactly what is happening in the market, what traders or investors are doing. That is kind of, it gives us a footprint of the market activity. It also gives us the bid quantity, bid ask, and ask quantity. That means what are the rates that are going on right now. So for example, here, if I want to buy this 2700 contract, I am willing to pay 466 only for that, per contract, whereas the seller is asking me 502 rupees. So that is called as a ask and bid. Seller is asking for that much price, and bidder is ready to bid only that much price. So whenever these two prices match, somebody yields, and then someone who is anxious to buy something, he said that okay, let me buy it at 441, uh, which the seller is asking for. So that's how the trade happens. So this gives us the idea about how the sellers and buyers are placed in terms of their expectations. If there is a wide difference between these two prices, then there is a large amount of volatility in the market about those positions. So, for example, if we go to the 3100, there is not much volatility, because it is a very closely, or rather followed contract, and people are the difference between the ask and bid is not that big a difference. So that's how you interpret this option chain that is freely provided by NSE website. Many other broking platform, they also provide their own option chain, like Angel One, Five Paisa, Sher Khan, Zerodha. They all have their own option chains also. If you have a broking account in any of them, trading account, you can also get to see there. Besides that, there is a whole lot of other information. You can explore it on your own later on. With that brief background, I'm really rushing through it because we don't have that much time. It actually is a 1 week course to cover all those things. But I'm just introducing you and encouraging you to go through it, study it on your own later on with the help of all those sites, free websites that I just showed you. I just, while we are talking about various websites, I also would like to take you to this screener website, screener.in. This gives whole lot of fundamental information related to those who are interested in fundamental investment. They give a whole lot of information like uh, what is the last 10 years sales figures, what is the last 10 years operating profit numbers, what are the operating profit margins, whether it is increasing or it's steady. So I've selected here Barbecue Nation as the company, and I'm looking at this data. You can look for any other company also. For example, if I look at ITC here, search for a company, ITC. ITC, I think recently had published their results. So if I go to their quarterly profit and loss account in December, their operating profit was marginally higher instead of 6,454 to 6,504. So just 50 crores more. So therefore, you would have seen the reports in your newspapers and magazines that ITC has exhibited subdued performance or something like that. Further, it gives some more information also. It gives profit and loss for the yearly as well. It gives some more information about your balance sheet. What is the borrowings? So for whole last 10 years, the borrowings of the ITC has remained quite stable that way, hardly increased, 118 to 284. 100 crores over 10 years is hardly anything. So you can go through this site also. Those who are interested in fundamental information can go through this. It gives information about your cash flows also, various ratios and things like that, shareholding pattern. So you can make a note of this website as well for fundamental information. So with that, I'll go back to the presentation and we'll go to the uh, uh, one example of option strategy. Now, this strategy is called as a short sell ATM straddle. So don't get scared with those names. First of all, option strategy itself might be new to some of you. Short sell is probably new to many of you. And ATM, we just talked about what is ATM, and then straddle. So we'll just go back to the option chain and see what we are doing here. So this is again a Nifty chart. So I will show the Nifty chart here. I mean Nifty option chain here. I will select Nifty here and I will go to ATM. ATM is the nearest 100 of the current price of Nifty. So it is 21,500. And here there is a call on this side and there is a put on this side. So if I sell something, it is called as a shorting. So I will sell 21,500 call and I will get this premium as a seller and I will pocket this uh, amount premium because of I'm shorting it, I'm selling it. So in return, I get some money, whatever I'm selling, and buyer provides that money to me in form of a premium. Similarly, I'll be selling a put also at this price 124.90. So the total gain that I will have is 170 plus 124 or 25 if I round it off. So totally, no, roughly about 294. So that is the amount that I will collect as a part of this short selling. So short selling a put and a call at a ATM price is called as a short selling of a straddle. Straddle is nothing but buying or selling of call and put. So that is termed as a straddle. So you can read more from the trading, the Investopedia chart. It will tell you more about what is the straddle, etc., and what is short selling is straddle. And then we go to this particular, so we have seen what is short straddle for Nifty. I go back to this presentation, and this is the options payoff chart. So the example, when I chose this, that time the option straddle price was 21600, strike price was 21600, and therefore I have used that as an example. And I have not written the price, but we have just now seen that the collected premium is 295 rupees. So something similar I would have collected at that point as well. So this maximum tip of the this particular cone here is the maximum gain that I have got. I will not gain anything beyond that. That's the maximum gain. At that time, it was 250 something, 260 maybe. So that is the maximum gain that I would make as a seller out of the selling of a straddle. And as the prices move on either side, I am liable to run in. It's possible that I'll incur losses moment it goes beyond this particular level where it is crossing the zero line. So from here onwards, I will start making losses, but till this point, I'll be in the money. I'll be making some money at least, or I will exit my position at break even if I am able to exit my position at this point. So it's also called as a break even point. So as long as the price stays within this, the instrument Nifty price stays within this region of this triangle, I will be making money. So many times people get into this position, short selling a straddle at the expiry, because at the end of the day, anyway, those options are going to expire worthless if the Nifty price remain within this zone. And I'll be able to pocket whatever money I've collected as a premium at the end of the day. So that is the benefit of the short sell ATM straddle, and this is the option chain. And I'll just explain you how we make money out of it, etc. What is the break-even point when I start making losses? Theoretically, it is likely to make infinite losses if the prices go down suddenly in a day itself, in an hour. It goes down 1,000 points. You are likely to make huge losses. But that's where your strategy comes into play. If you put a stop loss here, so your strategy will exit at this particular strike price at 21350. If it goes below that by 10 points, you will just say, okay, bye bye, I want to exit the position now. And you will come out, you will be saved by getting into only minimal losses. 10 rupees loss per lot, this is about 500 rupees. Whereas if you wait for 1,000 rupees fall, you are likely to make 50,000 rupees loss. So that's where the strategy comes into the picture. It will ensure that you are exiting on time. You are entering also the position at right time early in the morning where the premiums are more. You will be entering in the strategy position at the maximum price. You will be able to sell a straddle at a maximum price and eat that entire profit during the day if the price does not go beyond this triangle. So that's in brief the option strategy for ATM straddle, short sell, ATM straddle. So probably you will um, take a look at the uh, actual code also, how to code this particular strategy using Python built environment that we have in our AlgoBulls platform. So that's a brief introduction from my side about this, no, the entire strategy as a process and strategy as a product, end product for us. Finally, the evaluation. You also need to evaluate the strategy that you develop, and the major criteria that you use to evaluate a strategy is whether it is making profit or not, how much profit it is making, whether it is making just 5 6% or whether it is making 50 60%. So from that yardstick you measure the profitability of the strategy. Another parameter that you use for evaluating a strategy is the risk. So while you're executing a strategy, it may go down 30% suddenly. You have deployed capital about 1 lakh, and suddenly the value of that investment becomes 70,000. So that is called as a drawdown. And if the drawdown is more, if it is 30, 40, 50, 60%, then it is called as a risky strategy. Nobody would like to invest in that. Ultimately, it might be bringing you profit, but as you know, as we had talked about, the greed and the fear, people get afraid of the drawdowns. If it is incurring huge losses, even though it's a position in between, finally you may end up making profit, but people tend to give up. Moment see they see a they see a loss in their position. So from that perspective, from the risk perspective also, you need to look at your strategy, how it is performing. And in terms of consistency, is it sometimes giving 2% profit, sometimes giving 100% profit, and things like that? And it is important for us to consider that, because the day when it is, getting into losses, I might be trading using that strategy and I'll end up making loss. But the day when it is making huge profits, for some reason I forget, or I don't get time, I don't get opportunity to start that strategy, and I don't execute that strategy, and I end up missing that opportunity of huge profits. So consistency also is important. How consistently is making profit every day, every instance of execution, whether it is resulting into profit or not. So these are the evaluation parameters that one needs to look into once you develop and backtest the strategy. Backtesting will provide you the data required for this evaluation. That's why the backtesting is important. So with that, I think I will conclude my presentation. If you have any questions, I'll be glad to answer them. Hello.
I think there are no more doubts.
Okay, great.
Rajiv, for such an insightful session. So thank you everyone for joining. So also we are releasing a poll to know if you want a coding session. So please vote your opinion.
Okay, so I see a lot of questions regarding how they can plan the hackathon and what exactly they want there. So I'll give you all the details on 1st of February in the pre-event webinar. But because you have a doubt here, I'll give you a brief on what you have to do. So you will be given a certain market scenario where you have to backtest your strategies. You can backtest your strategies from a period that is given there. You have to choose from our ready templates or you can create your own strategies. Okay. And depending on what strategies you create and the backtesting you are doing, you have to generate a gross ROI, and the team or an individual with the highest gross ROI over the 9 days that we have for the competition will be the winner. So, how you have to create the strategy, how you will be backtesting, how does the platform work, everything will be explained in the pre-event webinar that is going to be conducted on 1st of February. So it will be very ideal if you all join the webinar on time and you can come there with all the questions. In addition, uh, every one of you must have joined Unstop. You have all the details there. Go check out the links given on Unstop and register on the competition.algobulls.com. Once you are there, make sure you follow all the rules and explore the platform before you come for the pre-event webinar. So that will help you understand a lot better on what I'm explaining and what other aspects are being shown to you. Okay. Okay. So this, do you have any doubts that you want to ask Rajiv ji and he can answer your questions regarding market and creating strategies? Okay. So Rajiv ji, Lennon has a question. He
Uh-huh.
wants he is asking, can you explain the bid and ask price in the NSE option chain?
Sure. So let us look at this particular example. 21,500 is the strike price, and here the ask price is 170 and the bid price is 167.95. So bid price, as I said, is the price which the buyers are willing to pay. So that is my price that I am willing to pay as a buyer, and the seller is willing to sell it at only at a price of 170. So there is a difference. So till this difference is bridged, there is not there is no possibility of actual trade happening. But this gives us an indication as to what is the current scenario as far as the um, uh, transaction involving this particular strike price is concerned. So that is the ask and bid price, and the ask quantity and bid quantity also is mentioned there. So there are no, the quantity that is at stake is about 200. The person is willing to buy 200 quantity, and this person is willing to sell 100 quantity. So if somebody wants to execute a trade, he can buy 100 quantity and remain with this his remaining quantity as an open position, which he may fulfill later on. But that's what the purpose of ask and bid rate and quantity is. I hope it is clear.
Okay. Okay. Thank you, Rajiv ji. So Arush is asking, will we have another session like this tomorrow? So, Arush, uh, the thing is that we just had a poll. The poll was regarding if you want coding session for coding also, and the poll mostly has answer yes. So we'll soon organize a session where we will teach you how to code your strategy from scratch. It'll be majorly for both the both equity and option strategies. So we'll let you know on when we are planning the workshop. But ideally, we'll be planning this workshop after I've explained you all about the product and you are well aware of the platform. Once that is done, it'll be easier for you to grasp on how you'll be able to create your strategies. Okay, so ideally, it'll be the workshop will be conducted after 2nd of February in the first few days of the competition. Okay, all right. Anybody else has a doubt or query, please let me know. So, Rajiv, your question for you is uh, can you tell the fundamental difference between option and future?
Yes. So future is a, I would say, equivalent of actual transaction of an instrument. Like you buy Reliance stock using your cash, you can trade the same way using the future instrument. Only thing, the difference there is that there is no actual delivery of futures in the trade that you have in futures. It's it's required to be uh, it's required to be covered at the end of the expiry. It needs to be reversed. Whatever may be the position. Suppose if you have, uh, I'll show you here. Here it also gives, NEC also gives the futures contract. So you just remember this Nifty price is 21,522. And if I look at Nifty futures, index futures, its 29th February contract is trading at 21,625. So it's almost 522 and 625. So 100 rupees difference is there. So index futures are generally higher. So what it means is that you can buy or sell the futures instrument at this price with an understanding of that you will you will buy the Nifty instrument at whatever price that is currently available at the expiry period if you have sold it, and if you have bought the futures you will be required to sell that. So basically you will be closing your positions. A person who has bought it and person who has sold it, they will be covering their positions by reversing the transactions. The person who has bought it, he will sell it, and the person who has sold it, he will buy it. So this is a replacement of a cash transaction. You can buy in larger quantities with a lesser amount that you have. So Nifty, for example, uh, if you were to buy 21,500 quantity 50, that will be uh, that will be involving some amount of 21,000 into 50 will be how much? 21,000 to 50 will be 2 lakhs, 5 lakhs, 10 lakhs. 10 lakhs of rupees will be your price. But if you're since you're buying it in future, it will be available to you at a price of about less than 1.5 lakh. So you take larger position, you can place larger quantities at a lower margin, lower capital outflow from your side. So you have to have that 1.5 lakh rupees in your account. It will be kept by the broker as a margin. And once you settle that contract, whatever may be the difference, if that price instead you had bought it at 21,625, and if it closes at 21,700, suppose, that means you are making 75 rupees profit per unit. So multiplied by the quantity that you have sold, you will gain that profit and the broker will settle that position. So other person similarly broker will settle, rather the exchange will settle that position with the buyer and the seller. Buyer and the seller, themselves don't have to do anything. So that's how the futures work. It's a leveraging kind of opportunity for the investor. Whereas the option, as we saw, if you want to buy, so like minimum lot quantity for Nifty is 50. You have to buy 50 units. So here you will see a lot of positions where the quantity is 50. So so here also, for example, 21,400, you are taking a call position at strike price of 21,400, and you will have to pay only 232 into 50. So instead of 21,000, you are paying only 232. So it's almost 1/100th of the capital that you have to shell out for that particular transactions. So with the margin money, you are reducing it to 1/10, and with the call options or put options, you are further reducing it by 1/10. So that is the advantage of options. The position is the same. Your view on the market is the same. If you are buying something in cash, you are bullish about that particular instrument. If you are bullish about that particular instrument, you may buy it in futures also with a smaller amount of capital and larger quantity. But your view still remains the same. You are still buying something. Similarly, if your view is bullish, you can do it in 1/100th of the capital by placing a option call buy order at a 232 rupees. So 1/100th of the actual price. So that is the advantage of options and futures. So usually nowadays, most of the people work with options because the capital requirement is very less. That's the advantage. Otherwise, logically speaking, there is no difference between buying a call or buying a future or buying an actual instrument in cash. All of them are indicating a bullish view that an investor has. It is just the margin and the leveraging that you get out of these instruments.
All right, I think that must have cleared a lot of doubts here. So, okay, I'm guessing there are no more questions. So, I'm still giving 10-20 seconds of time. If you have any more doubts, please ask your questions. Okay, so I think that is it. Okay, sir, how to start which algorithm?
Okay, so should we wind up?
There's one last question that we'll take.
Okay,
The question is, sir, how to start with algo trading in stock market?
how to start with algo trading?
Yes.
So if you are a programmer, so your viewpoint will be different. You will first need to learn some programming language that is required to build that piece of code. And for example, now this particular competition is there. There you will get to know about how to code the strategy. So you can make a start over here by developing your own code, or you can use the existing template that is available to build your code. And once you get hang of it, how to code and how to start, you can then expand on it. But if you're asking as a user, if you want to start uh, using algo based trading, then you should catch hold of a platform like AlgoBulls, which will help you to strategize your logic that you have in mind based upon the market scenario, as I had explained earlier. The market scenario, market situation, and your response to it in form of your logic. And AlgoBull will be able to help you in uh, translate it into a code which you can then start using. So these are the two views to look at the strategy: as a user, as a developer. As a
Okay.
developer, though, I would add one thing, that you should start learning more about the markets. All the concepts that are introduced, they are just the bare minimum. I've just touched upon them. You may not have understood all of them also. I don't claim that all of you would become expert after listening to my session for 1 hour. It is just an introduction. It will tell you where to look for the information that you may want. So that is the purpose. So you start picking up that information. To be a good programmer, you need to understand the business aspect of it also very well. Otherwise, it will not match. Yeah, that's what I feel.
Okay. Any insights on intraday there, Rajuji?
Intraday.
Yes.
Intraday is, I mean, rather I would say what should be, look for the other strategies which are not intraday. So that will be easier for to deduce what is required for intraday. So, other strategies are called as a delivery strategies, meaning you build a position on first day, and then you carry forward that position till you exit from your strategy. So for that, you need to have good understanding of market, how it is going to move in next few days or weeks, and based on that you can strategize, because there it is assumed that you are prepared to face certain amount of losses for a short duration. For example, there is something called as a calendar strategy. A calendar strategy would start with a loss to begin with, but as things progress, that loss starts reducing, and your profitable positions start building more profit for you, and at the end of the period, you end up making profit. So you need to have good understanding of the market before you take the delivery trades. So for intraday, what you need to understand, I mean, one typical theme that is used by many people is the theta decay. So theta decay is again different concept, which you may read upon on yourself. So basically, what it means is that at the start of the day, all these options have a certain price, and if the actual underlying price of the instrument doesn't move here and there, stays at that price level only, then this options that you have sold, you pick up those pocket those profits, and because the options at the end of the expiry, they expire worthless, they become zero. So you don't have to pay anything out of your pocket at the end of the day, and you pocket that profit. So that is a typical theme that people use for intraday, essentially theta decay.
Okay. So, Ragul, we'll be showing you the code for the strategy and its backtesting results on 1st of February in the pre-event webinar. We'll also be conducting a coding session for you guys so you can know how to code our strategy from scratch and also review the codes from our templates. You don't worry on that. Make sure you join the Algo Trading Ninjas community. The link has been shared in the chat before. I'll request Samruddha to please reshare the link so folks can join the community. All the communication and all the introduction questions can be asked there. We'll let you know everything there. Whatever insights are and whatever updates are on the competition, you will also get the information from there. Okay. So now that you have the link and if the session has been conducted fruitfully, I'm expecting all of you have learned a lot, and we are coming with more such sessions for you. So this competitions can be really fruitful for you guys. And with that, we'll wrap up this workshop and expect to see you soon on 1st of February and other workshops that we'll be conducting. So thank you everyone for joining this session, and best of luck for this competition.